Hello everybody, George Peacock, founder of Fear-Free Investing and manager of the Purchasing Power Portfolios. Welcome to the Fear-Free Investing video about investment costs and fees. In this video, I'm going to cover the typical fees and costs that investors face, how to identify them, how much they really cost you over time, why so many people pay such high fees, and most important, how to lower them. I spend a little more time on this topic and have some additional resources in the Intro to Fear-Free Investing DVD package. But by watching this, you will learn everything you need to know and get practical information about what you can do about it. The very practical goal of managing your fees is to keep as much of your money growing in your accounts so that you are the one going to Disney World with your family or buying the new car or buying the second home with your money and not your advisor. Perhaps one of the silver linings to come out of the most recent financial crisis is that with such low returns, particularly in the cash, CD, and bond markets, investors have a heightened awareness of fees and taxes, of course, but that's another topic. Many people I know who had been willing to pay 1 to 2% or more to their advisor during times of 6% CDs and a 10% stock market are seriously rethinking that willingness. In fact, recently I had lunch with a friend of mine who told me he was totally changing his relationship with his financial advisor. When I asked why or how, he said he was changing it because of the cost of the advice was increasingly high relative to the returns he was getting. That's a new reason that I'm hearing, and I'm hearing a lot more of it. But as Vanguard's John Bogle has been saying or shouting for years, fees always matter, and fees are one of the things that you actually do have some control over. I will show you that even in fact especially in, good markets, most investors are sharing way more of their potential gains than they know. I will show you why and how many investors are willing to pay $650,000 to $1 million more than necessary for an advisor to manage a $250,000 portfolio. Seems strange? Keep watching. So let's address the costs and fees within the system. One reason that fees are so high is because there are two layers of fees. The first layer is the underlying investments themselves, which make up one's portfolio. This is usually accomplished by using actively managed mutual funds, index funds, exchange-traded funds, but basically let's just call them stocks and bonds. For the purposes of our example, let's keep it even simpler. Let's assume that your advisor recommends that you have a portfolio that's made up of a bond mutual fund, a U.S. stock mutual fund, and an international stock mutual fund. So you have 3 mutual funds in your portfolio, each taking up 1/3 of the portfolio. Now each of these mutual funds will have its own objective. For example, the U.S. stock fund portfolio manager will invest in the stock of companies that are based in the U.S. Usually this is a part of the portfolio that one hopes will grow in excess of inflation. And each of these funds will also have its own expense ratio, the cost of running the fund. With the mutual fund, you and other investors of similar objectives pool all your money together and hire a firm and an advisor to manage your money. There is an expense to this, of course. The average expense ratio for a U.S. stock fund is in the order of 1 1/4% per year. The bond fund will have a lower expense ratio, and the international fund will tend to have a higher expense ratio. When you average out the costs of the 3 funds that you now own, let's assume that the average expense ratio is about 1%. In truth, that might be a little low based upon the portfolios that I've reviewed, but let's stick with 1%. Unfortunately, the expense ratio is not the only cost that you incur as a mutual fund investor. There are also brokerage and trading costs that the fund incurs, and these are not considered to be part of the expense ratio. So depending on how actively traded a portfolio is, the effect of these expenses can be significant. And there are other indirect costs, but we're going to ignore them for the sake of this example. I've attached an article about the full costs of mutual funds below. Let's assume for the sake of our example then, that the trading and brokerage costs add another 1/4% to our expense load. Thus, for the 3 mutual fund portfolio that our advisor has recommended, the average expense ratio is 1%, and we're adding another 1/4% in trading and brokerage fees, resulting in a total cost of our portfolio of 1 1/4% per year. We're going to call that just the cost of our portfolio, the first layer. The second layer of fees are those fees paid to your advisor for selecting and monitoring those 3 mutual funds. He's getting paid for choosing the best bond fund, the best stock fund, the best international fund. He's also getting paid for coming up with the right percentage mix. Now in our example, each fund represents just 1/3 of the portfolio. And in real life, virtually no advisor would recommend such a simple portfolio with 3 equally weighted options, if for no other reason than the worry that her client will assume that this was very easy to do. Now I'm also going to spend most of video 3, the asset allocation fraud, talking about how that mix is usually arrived at by most advisors these days and why that current methodology does in fact border on fraud. Incidentally, if your advisor has given you an asset allocation report recently, I have a list of questions you may want to send to him or her. And if you relied on it in any way, you're going to want to watch video number 3 as soon as we make it available. Anyway, for selecting the right pieces and for the annual monitoring of your portfolio, your advisor will likely charge you, let's say, 1% per year of the assets under management, give or take. Thus, the cost of both layers in this example is 2.25%, 1.25% for your portfolio and 1% to your investment advisor for his portfolio advice and ongoing monitoring. I should add that there's often additional non-portfolio related financial planning advice as part of the investment advisory fee. And frankly, I think that's good. Financial advice is often very valuable. It's certainly more valuable than constructing and monitoring your portfolio, because that is really something you can do on your own, as I will show you in video 3. For reasons that will become clear, I recommend that you pay for these financial planning services either by the hour or due to a flat fee negotiated with your planner. You'll see why in a moment. So back to our example. The total cost for our example, which is admittedly a bit low for a lot of investors who use advisors and actively managed funds, is 2.25%. Let's lower it even a bit more and use a flat 2% per year. Now let's assume an investor has a $250,000 portfolio and that she earns 8% before fees for the next 25 years. Due to what Einstein called the 8th wonder of the world, compound interest, that $250,000 would grow over 25 years at 8% to $1.7 million. $1.7 million before fees. Now, that same $250,000, if you had a 2% expense load, would grow only to $1 million, a difference of nearly $650,000. $650,000. That is the difference that a 2% per year expense can make. That is money that would have remained in the investor's account if he had reduced his expenses by 2%. Now that sounds very different from, I charge 1% of assets under management, doesn't it? $650,000 is almost 3 times the initial amount invested. Let me ask you, if during your first meeting, your advisor offered to manage your $250,000 for the next 25 years for $650,000, how would you respond? These days, most people say sure. Again, all things being equal, and I'll show you that they're not, that is $650,000 that could be going into your account or staying in your account instead of going to the shareholders of your mutual funds and your advisor. Going back to one of my earlier comments about the potential value of financial planning, even if you used $20,000 for some financial planning issues along the way, you would still come out quite far ahead. Okay, I said earlier that in markets with greater returns, the effective cost is even greater. So let's return to our earlier example. As we saw, $250,000 at 8% over 25 years grew to $1.7 million. But what if 8% was the after-fee return? That is, what if the actual return was 2% higher? The before-fee return would have been 10%. What do you imagine the before-fee total would be if the $250,000 earned 10% over 25 years? Well, the answer is $2.7 million. 1.7 at 8%, 2.7 at 10%. That makes the effective cost to the investor a clean $1 million, significantly higher than the $650,000 disparity we saw between 6 and 8. This happens due to the effect of the loss of growth on the money that is otherwise paid in fees. And as returns are greater, the loss of not having that money in your portfolio becomes greater as well. So while most people tend not to focus on fees in good markets because their net return feels adequate to them, the truth is that the better the market, the greater the effective costs over time. The question is then, if fees are so high, why is the market, why have investors allowed it? I think pretty simply it's due to confusion and conflation. To understand what I mean by confusion, I've attached an article by industry advisor Bob Veris. You'll see that different advisors do charge different ways and different amounts for different things. That makes it very confusing for an investor. As for conflation, as I said, most firms now provide financial planning advice as part of the investment management fee. Rather than paying for financial planning separately, for example through a flat fee or by the hour, investment advisors provide that financial planning advice as part of their 1% fee. And most investors, when faced with the idea of having to pay $150 an hour right now, are very pleased to hear that that work can be done for free if they just end up investing with the advisor. In the end, however, we clearly saw that that is a very bad bargain. Investors would be far better off paying the hourly or flat fee rather than the percentage-based fee that is attached to the investment portfolio. Although there are indeed many different ways that advisors charge their clients, it is very common to encounter a fee of about 1% of assets under management. The fact that it is so common is a form of informal collusion that benefits the industry. You see, it creates for investors what we call a presumption of value. Another reason that fees remain high is that advisors and firms have the upper hand in the knowledge asymmetry game. It's easy for them to know more than the typical investor. And that is also aided by the fact that Wall Street causes so much confusion and noise. Now also, and perhaps most dangerous, the fee is usually expressed as a small percentage of total assets. As you saw, the nominal amount is a little more off-putting. And finally, another reason that fees remain high is that most people never get a bill. Mutual funds deduct their share of the fee every day, and it's taken out of the end-of-day price. And most investment advisors deduct the fee from a client account each quarter. You can see it's very different when somebody doesn't get a bill and doesn't have to make a payment. So as you can see, although clients voluntarily and routinely agree to pay fees, they don't do so in a truly informed manner. There's a lot working against them. As a result, as I said, most consumers don't even try to minimize their costs because they don't know how. So now, knowing all of this, knowing the effective fees, what could you do? Well, you could immediately, either on your own or by instructing your advisor, make sure that every mutual fund that you use in your portfolio be a low-cost index fund. That could lower your average cost from 1.25% to 0.25% or even lower. For example, Vanguard's total stock market fund expense ratio is 0.05%. So that would be layer 1, your portfolio expenses. As for layer 2, your advisor fees. Well, clearly, if you took over the asset allocation and monitoring of your portfolio, you could save the full 1% advisory fee. Now, I wouldn't suggest doing that until after you've watched video 3 on asset allocation, though. But after that, you really could do it on your own, and you might even want to give it a try. And I think you should. Again, after watching the video, you'll know why I say that. But even then, I know that some people do want to work with an advisor, if for no other reason than to save their own time and to have someone rebalance the portfolio as appropriate. Keep an eye on it. That's fine, but make sure you find someone willing to charge 0.25% or less for serving as your investment administrator/manager. If you do already have an advisor, you can basically go to your advisor with the Fear-Free Asset Allocation that you construct after watching the Intro to Fear-Free Investing DVD and say, will you manage this? Will you administer this for 0.25% per year? If he says no, find an advisor who will. They do exist. You can find such an advisor using the Choose an Advisor method that we suggest in video number 2. So, let me summarize a bit. Because of the two layers involved, most investors are still paying in excess of 2% per year in investment-related fees and costs, with many people really paying 2.5% to 3%, often without even knowing it, because they never get a bill for anything. Now, if you really want to feel good about your new focus on fees and on bringing your costs down, consider the case of CalPERS, California's pension trust, the first largest public pension in the country. They have about $255 billion in assets that they manage. Currently, 50% is in low-cost passive index investments, and 50% is with various actively managed advisors, who clearly cost more. CalPERS just announced that they are likely in the fall to start using 100% low-cost passive investments. You are in very good company. You should know that there are advisors in the marketplace who will charge significantly less than the 1% annual market price. Find those advisors. Again, in video 2, we will give you some strategies for doing just that. Now finally, I want to tell you briefly about our Silver Level membership. The Silver Level membership includes the Intro to Fear-Free Investing DVD set, a free bonus copy of Michael Eddis's book, The Big Investment Lie, which I believe is the best and most comprehensive book about Wall Street's personal financial industrial complex that I have ever read. It is so comprehensive and it lays it out very, very well. It is a great read. You will also be subscribed to our member blog, which will continue your path of learning and provide you with ongoing financial planning information and information which will help you manage your portfolio on your own or in partnership with your advisor. And finally, you'll be invited to special and private webinars on financial planning topics and strategies, as well as members-only author interviews. Now, in our Introduction to Fear-Free Investing DVD, I spend a little more time on fees and costs, including some specific recommendations, and I also provide a video to show you how to calculate what you are paying in fees and how to determine the long-term effects of costs to you, given your situation. And therefore, you can know what you could save. I also cover choosing an advisor and provide you with proprietary methodology and checklists and email templates for both finding a new advisor as well as for evaluating your current relationship. Further, I not only address asset allocation generally, but in the DVDs, I'll show you exactly how to construct and manage your own fear-free portfolio. You'll learn more about that in video number 3 as well. If you want to learn more about the Silver Member Package, just click Join Now on the right side and watch the brief video that describes everything that you will receive. We have a 100% money-back guarantee. Simply, if you don't get the value you wanted, if you don't get the value you had expected, or the value you had even hoped for, send us an email to refund@fearfreeinvesting.com or call me directly. I give you my direct number in the DVD. I hope you've learned something in this video and that you use this information to save a whole lot of money. I also hope you'll join me to hear about how to choose and assess an investment advisor and to hear about the sorry and dangerous state of asset allocation programs today. I'm George Peacock, and thank you for your time.